Welcome to the Deep Dive. Today we're tackling a decision that I think a lot of us have faced, and it can be pretty stressful. When you need a bit more breathing room on your credit, what's the smarter move? Do you ask for a limit increase, or do you go out and apply for a whole new card?
It sounds like such a simple choice, right?
Sure.
But it has these huge ripple effects on the long-term health of your credit file. So our mission today is to really get past the usual blog post advice. We're going to dig into financial regulations, consumer studies, and even some behavioral science to see what's really going on.
Absolutely. And to do that, we have to start with the language lenders use. They have these two core ideas that most of us probably mix up: creditworthiness and affordability. Let's unpack those.
Yeah, they are not the same thing at all. When a lender looks at you, they're assessing two very different risks. First is creditworthiness. That's all about your past. It's your track record.
Like a report card.
Exactly. It's a report card. Have you shown the ability and willingness to pay your bills on time? It's all about your history and your likelihood of defaulting.
Okay, so that's the past. But then there's the second pillar, affordability, which feels much more about the here and now.
It's entirely about the here and now and looking forward. Affordability asks a different question. If we give you this new loan, can you handle it without causing yourself real financial pain?
Without it pushing you into distress.
Precisely. You could have a perfect payment history, be super creditworthy, but if you're already loaded up with debt, another loan is just not affordable.
And that's the real aha moment, I think. It is not just about your score. It's about whether this new debt pushes you into what the literature calls over-indebtedness.
Right, and they actually put a number on that. One of the key indicators they talk about is when you're spending more than 25% of your gross income just on paying back unsecured loans.
25%.
Yeah, not your mortgage, just things like credit cards and personal loans.
Wow. That is a huge slice of your budget before you've even paid for rent or food.
It's a massive red flag. Now, the sources are, they're quick to point out that it's not a perfect measure for everyone.
Sure, context matters.
Exactly. But for a lender, it's a clear, measurable line in the sand.
Okay, that makes sense. So let's pivot now to the metric that we as consumers actually have some control over, and the reason we even think about this stuff: credit utilization.
This is where the strategy really comes in, because for most people, the main goal of getting more credit is to improve their credit utilization ratio, or CUR.
Right, the CUR. Let's define that really simply for everyone.
It's just the amount you currently owe on your credit cards divided by your total credit limit across all of your cards.
So if you owe $2,000 and your total limit is $10,000, your CUR is 20%.
Exactly. And the golden rule you hear everywhere from all the consumer groups is to keep that number below 30%.
And ideally, way lower, right? Like under 10% is where you really want to be.
Oh, absolutely. The closer to zero, the better. But 30% is that psychological threshold where lenders start to see you as a higher risk.
So when you need more credit, you're either making room for a big purchase or you're trying to lower that ratio by increasing the denominator, the total limit.
That's it. It's a math problem. You want to make your overall limit higher so your spending looks smaller in comparison.
Which brings us right back to the central choice: new card or limit increase. Let's do a head-to-head. What are the pros of just applying for a new credit card?
Well, the upsides can be pretty tempting. You get access to a big sign-up bonus or maybe better rewards or even a 0% APR intro offer, which can be huge.
The shiny new object with all the perks.
Totally. And it immediately increases your total credit limit, which helps your CUR right away.
But there's always a catch. And the big one here is the hard inquiry.
This is the critical part. When you apply, the bank does a hard inquiry. It's a formal check on your credit file, and it will usually cause a small temporary dip in your score.
And if you have a bunch of those in a short time,
It looks bad. It signals that you're desperately seeking credit, which makes lenders nervous. It's a definite red flag.
And the other big drawback is what it does to the age of your credit file.
Yes, this one is huge. Opening a new account lowers the average age of your credit history. If you've had credit for, say, 20 years, it's not a big deal.
But if you're just starting out,
It can be a major hit to your score.
okay, so if the main goal is just to fix your CUR without all that disruption, then the credit limit increase, the CLI, seems like the safer play.
It's definitely the more surgical approach. If you get it, your utilization drops instantly, and it does absolutely nothing to the age of your credit history. Plus, it's just simpler, one less bill to track.
But we still have to talk about that hard inquiry risk. Is a CLI request always safe?
No, and this is the key. It is completely dependent on the bank. Many big issuers will only do a soft inquiry for a CLI request that's invisible to other lenders and doesn't affect your score at all.
But not all of them.
Not all of them. Some still treat it like a brand new application and do a hard pull.
So you're taking the same score hit as a new card, but without any of the rewards.
Exactly. And that's why the common wisdom is to find out your bank's policy. If they do soft pulls, ask every 6 months or so. If they do hard pulls, you save that request for when you really, truly need it.
And when you do ask, what are they looking for? They already have your whole history with them.
They're looking at a few things. Your recent behavior. Have you been using the card responsibly? They're also looking at your overall debt-to-income ratio.
So if you've paid off other loans recently, that helps.
That helps a lot. And finally, timing is everything.
Right.
Don't ask for an increase right after you've opened the account or right after you got your last one. They want to see you handle the current limit well for at least 6 to 12 months.
That all makes a ton of sense. But now I want to shift gears and look at this from the lender's side, because this is where the psychology really gets interesting.
Yeah, the academic literature is very strong on this point. Responsible lending isn't just a one-time check at the beginning. It's a continuous duty.
Which leads directly to the controversy over unsolicited credit limit increases. When the bank just gives you a higher limit without you even asking.
It's a really contentious practice. Banks have argued that they're providing a valuable safety net for emergencies.
But it feels a lot like they're just tempting people to spend more.
Well, the research seems to back that feeling up.
And the numbers from the source material are pretty stark here.
They really are. One big study found that these unsolicited increases do encourage people to spend more. On average, they saw a 23% rise in spending on that card right after the limit was raised.
23%. So people don't treat it like a safety net. They treat it like newfound money.
It seems to trigger a sort of failure of self-control. The money is there, so it's just easier to spend. It connects to this idea of mental accounting, where you see that new credit as separate from your actual budget.
Which is a perfect segue into this other major behavioral idea, what the experts call the credit card debt puzzle.
This is a fascinating one. The puzzle is this. Why do so many people who are revolvers, meaning they carry a balance from month to month, keep doing it, even when they have the cash in a bank account to pay it all off?
Yeah, why pay 20-something% interest if you don't have to? It seems completely irrational.
It does, and the explanations go beyond simple economics. It seems to come down to two big things. First, people place an incredibly high value on liquidity.
Just having the cash on hand.
Exactly. It feels safer, like an emergency fund, even if it's costing them a fortune in interest. And the second reason is, frankly, problems of self-control.
And this idea of prioritizing liquidity over everything else, it was taken to an unbelievable extreme during the U.S. financial crisis.
It was. It was a finding that shocked a lot of economists. During the worst of the crisis, some people made the choice to stop paying their mortgage.
And let the bank take their house.
Right. But at the same time, they kept making the minimum payments on their credit cards.
They prioritized a $5,000 credit card debt over their home. Why?
The theory is that they were trying to protect their last financial lifeline. The credit card was their only guaranteed way to buy essentials, gas, food, day-to-day things. In a crisis, that immediate access to funds felt more valuable than the long-term asset of a house.
Wow, that just puts everything in perspective. It's not about spreadsheets and interest rates. It's about fear and survival and the psychology of money.
It really ties it all together. Managing your finances isn't just about knowing the rules and the ratios. It's about understanding the complex psychological forces that drive your own decisions.
This has been such a critical deep dive. We went from those foundational lender definitions, affordability versus creditworthiness, to the hard math of the credit utilization ratio. We broke down the pros and cons of the new card versus CLI decision, and then we got into the really deep behavioral traps.
And gaining knowledge here means internalizing those numbers. Knowing that 25% of your gross income on debt is a warning sign, and that a 23% spending jump is what happens with unsolicited increases. The practical choice should always be about what helps your ratio the most with the least disruption.
Absolutely. So I'll leave you with a final thought to mull over. If the credit market is supposed to be based on rational consumers, why do so many of us consistently fail the simple math test paying incredibly high interest when we have cheaper options? What other forces beyond just liquidity or self-control are we still not seeing when we talk about how we manage our debt? Something to explore in your own deep dive.